If you've ever had to pick out an investment in a 401k plan or an IRA or something like that, and you're looking at mutual funds, you may have noticed this little percentage called an expense ratio listed somewhere near the annual average returns or in the other relevant stats that are related to that investment. Now, normally this number is less than 2% or even less than 1%, and it may seem relatively insignificant. But what if I told you that small number could have an impact of thousands, even hundreds of thousands of dollars on the overall value of your portfolio over time? And in this video, I'll show you how expense ratios can have a huge impact on your ability to build and maintain wealth. First off, let's talk about what an expense ratio is. An expense ratio is just a percentage of the net asset value of a fund or an investment that's withheld by the people who run that fund in order to pay for expenses like administration costs, legal fees, taxes, just the overall costs of running the fund, and to pay the salaries of the people who are actually involved in operating it. Now, there are a lot of limitations the SEC places on mutual funds and how they're organized, but what they actually invest in could be a very broad range of things. Some mutual funds and ETFs invest in a very small portfolio of assets, or maybe they focus on a particular asset class. Some may hold lots of investments, some may hold very little, some may turn over those assets frequently, some may turn over very, very infrequently. All those factors play into how much it actually costs to operate the fund. Not only that, but in a mutual fund, the assets in the account have to be sold or bought from time to time depending on people coming in or out of the account or moving money in and out of the fund. It expands and contracts literally with the flow of dollars in and out of the fund. Every time a mutual fund manager has to buy or sell or trade assets within the fund, there's a cost for that. Expense ratios are a critical step in making sure the fund can be managed profitably. So calculating expense ratio is really quite easy. You just take the percentage and divide it into total assets you have in the fund in a given year. So if you had $10,000 in a mutual fund and the expense ratio was 1%, then $100 of that $10,000 every year would be taken out of the account to pay for the administrative costs or expenses associated with the fund. Now, many domestic mutual funds and ETFs charge expense ratios below 1%. If you're looking at an international fund, typically there's more handling costs. It's just more expensive to operate those. You'll see a lot of those between 1 and 2%. But that cost has actually come down over time as trading has become more efficient and with the advent of index funds, which we'll talk about more in a minute. So they're actually a little less than they used to be. So how much of a difference could this little number make? I mean, at the beginning of the video, I told you it could matter thousands, hundreds of thousands, even millions of dollars over the course of many years. So it's not something you can afford to ignore. Now, to illustrate this, I ran a scenario where you had two investments that were identical in every way except for the expense ratios. We're investing in an S&P 500 mutual fund, which means we have an average annual rate of return of around 10.67%. The only difference is one investment has an expense ratio of 1%, the other has an expense ratio of 0.1%. Now, the good news is, due to compounding interest, both investments clear $1 million in 35 years. The bad news is the fund that had the higher 1% expense ratio cost its owner almost $120,000 more over that 35-year period. And over that period, the fund with the 1% expense ratio saw about $135,000 in expenses, while the fund with the 0.1% expense ratio saw cannibalization of around $16,000. And the balance of the fund at the end of 35 years with the 1% expense ratio was about $1.34 million, while the fund with the lesser expense ratio of 0.1% cleared $1.7 million. Now you'll notice that's over $350,000 difference in the total performance of the fund. Now, I told you earlier the numbers I gave you were just the cost. It didn't include the interest that was lost because of the money that was no longer invested because it was given away as an expense. So truthfully, the cost or the expense ratio of actually operating the fund is only part of what you give up. You also lose an opportunity cost for all the interest that those expenses could have been earning had they not been eaten up or consumed by the fund itself. We got a couple of graphs to kind of illustrate this. The first one you'll see is the two funds over time. The top line you'll see kind of goes up more. That's the expenses associated with the fund that has the 1% expense ratio, while the one at the bottom is the fund that had the 0.1% expense ratio. And you can see over time the gap just gets broader and broader. The bottom fund, or the less expensive fund, it just slowly creeps up over time, whereas the top one, in comparison, the expenses just grow at a much higher rate. The second graph is the overall performance of each fund over time. As you can see, the fund with the smaller expense ratio is just done much better than the one that had higher expenses. to the tune of over $350,000 difference by the time the 35-year period had elapsed. And the expense ratio for the more expensive fund was 2%. The total cost over that time would have been over $225,000 just in expenses and over $500,000 in lost investment or opportunity costs. Hey there, if this information is helpful or interesting to you, please show your appreciation by clicking like and subscribe below. We're trying hard to grow our subscriber base and our YouTube channel so we continue making videos and teaching people about personal finance. Now at this point you may be wondering, doesn't active management actually produce higher returns than funds with low expense ratios or funds that are connected to an index and aren't managed actively? Well, the answer is no. Studies show that 80% of actively managed funds actually underperform those that are passive and connected to some sort of market index. It's understandable to think that an actively managed fund would outperform a passive fund because if there's a human operating it, right? They can respond to economic factors and conditions. They can respond to changes in news and businesses and actually investments that are owned within the actual fund. Well, ironically, it's actually that human interaction that causes the fund to cost more, because every time there's a transaction, a trade, an adjustment of some sort, there's an expense that's incurred, and many times it's taxes. Anytime there's a trade within a mutual fund where there's a sale of an asset and a capital gain is realized, a tax has to be paid for that. And as those expenses increase, the ability of an actively managed fund to compete with a passively managed fund is eroded bit by bit. Of course, actively managed fund managers could just sit back and not engage in a lot of transactions and just let the fund do what it does. But then what would you need active management for in the first place? They have to justify their existence somehow, so they make trades and you pay for them. But we're not the first people to wonder why they're necessary. In 1974, a man named Bogle created the Vanguard Group. And after a couple of years there, in 1976, he's credited with inventing the first ever indexed mutual fund. It literally changed the investing world. And Paul Samuelson, who won the Nobel Prize for Economics, actually compared Jack's creation of the index fund to the wheel, the alphabet, and Gutenberg printing. You see, Bogle hated wasteful management of mutual funds, and he theorized that if he could just follow an index, it would provide diversification that you need in a stock portfolio without a lot of the cost. And he was right. For decades now, the popularity of index funds has soared. And from a personal perspective, I first discovered index funds in 2010 and changed everything. All the actively managed funds we had, we sold. We bought index funds instead. And since that time, we've seen about a 2% higher rate of return on average in our investment portfolio. So where do you buy index funds? Well, first I want to acknowledge something kind of unfortunate. If you have a 401k plan, there's a chance that you may not have an index fund available in that plan. Within a 401k, you're limited to the options that your employer actually puts in the plan, and if they don't have index funds in there, you're just out of luck. That doesn't necessarily mean you don't need to participate in your 401k plan. There's still a lot of great benefits like the tax-deferred saving. There's employer contributions and things like that. They're still very valuable. But if you're in an IRA or in some other brokerage account outside of a 401k, your options are much more flexible, and you should be able to find index funds. Now, index funds can follow a variety of indexes. They can follow the NASDAQ. They can follow S&P 500 is a very popular one. They can follow a total broad stock market index. They can follow international indices. They can follow bond markets. They can be sector specific. There's a great variety. But really the benefit boils down to there's no one at the wheel pulling levers constantly, making trades, running expenses up within the fund. You should be able to find index funds with expense ratios of less than 0.1%. In fact, Vanguard, where I do a lot of my investing, a lot of them are as low as 3 or 4/100%, making them virtually free. So hopefully this makes you look at expense ratios a little differently, maybe put a little more thought into the investments you buy, and hopefully maybe even turn your eye toward index funds if you've never looked at them before. The math simply shows that over time it can have a huge impact on your overall wealth. We have tons more about investing on our website and our channel here on YouTube. We'll put some links down in the description below to other posts that are similar and some playlists we have that are relevant to this topic. As always, we are grateful for your time and your interest in our videos. God bless and take care.